Hey, what's going on, guys? We have more updates to share about the housing market. And these are updates that is leading to a bigger bifurcation between buyers and sellers. And I think you're going to find them very interesting. We're going to cover mortgage rates. We're going to cover the jobs market. We're going to cover some of these real estate trends that are unfolding. Now, if you are new to the channel, I would greatly appreciate it if you hit that thumbs up and subscribe. Really helps grow and promote the channel, and I truly appreciate it. Let's jump into the data. 30-year fixed mortgage rate tops 7.81%. They surge. They're rapidly approaching the 8% level, which of course is dampening affordability, creating more problems here in the housing market. And for many, 7% was a psychological level. A lot of buyers who were sitting on the fence decided to pause once rates got over 7%. Well, what happens if we get over 8%, which in some cases, that is what is actually being quoted. And on that note, even though 7.81% is the national average, many lenders are quoting less. In fact, according to the Freddie Mac survey, the average 30-year fix is coming in at 7.49%. But what's interesting is the way they collect this data has changed. So as of November 17, 2022, they actually base this data on the actual applications received from lenders across the country. And they are no longer publishing the points, fees, and costs that are associated with securing that interest rate. So let's say the average 30-year fix is 8% for easy math, but a lender is quoting you 7.49%. Most likely that 7.49 comes associated with some kind of cost. They call it discount points, but it doesn't mean that you're necessarily getting a better deal. It's just the cost associated with securing that interest rate. So 7.5% may come with a 1% cost. And if you're taking out a loan for, let's say, $300,000, 1% of $300,000 is $3,000. That's in addition to the other closing costs. This is one of the things that I pay really close attention to, because if we zoom out a little bit and we look at the macro landscape, if in fact mortgage rates were to come down in, let's say, the next 6 to 12 months, I may want to take advantage of a refinance opportunity. Well, if I just sunk a bunch of cost in buying down the rate, that refinance opportunity may no longer make as much sense. Now, the jobs report actually surprised to the upside, creating 336,000 jobs. This is increasing far faster than most economists predicted. The prediction was that they would stay at or below around 200,000 jobs. It came in obviously way higher, but more importantly, it was falling at the upper level of this pre-pandemic range, which is what seemed to really shock the markets. With the strong jobs number that left unemployment levels coming in at 3.8%, that is unchanged, and this could ultimately lead to more inflation. And that's what we started to see pricing in here with the 10-year Treasury yield. As soon as the jobs report came out, we saw the 10-year Treasury yield spike. It did settle back down a little bit, but it ended up closing over 4.8%. And in a world where the Fed constantly reiterates data dependence, this is a big blow for rates. And this, of course, plays into that higher for longer scenario. Now, shifting gears slightly, it looks like the National Association of Realtors, NAR, calls for an end to the rate hikes as the pending home sales drop here as well. So they track the pending home sale index, PHSI, and it declined 7.1% to 71.8 in August and is now down 18.7% from its August 2022 level. And you can see how that unfolds here in this chart. These are the pending home sales. This is based on contracts signed during the month to purchase existing single-family homes, condos, and co-ops. These are actual signed agreements, and it is a leading indicator to those sales which are expected to close over the next 30 to 60 days. So you can expect that October, November, December are probably going to be some pretty slow months for closings here. Lawrence Yun, he is the NAR chief economist, and he had a few things to say. Mortgage rates have been rising above 7% since August, which has diminished the pool of homebuyers. Some would-be homebuyers are taking a pause and readjusting their expectations about location and type of home to better fit their budgets. And he goes on to say it is clear that increased housing inventory and better interest rates are essential to revive the housing market. In other words, the combination of constrained supply and higher mortgage rates have really stalled the housing market, causing both buyers and sellers to step aside and just wait for things to shake out a little bit. So the lock-in effect is continuing. You have sellers who don't want to give up their 3% interest rate, and you have buyers who are like, no way I'm paying 8% given the affordability challenges here in today's market. And this next chart provided by Redfin is really a good indication of the purchasing power of those buyers. So it's how much home can you afford as mortgage rates change. So let's say I was a potential home buyer in this market and I could afford a $3,000 a month payment. Well, if rates are sitting at about 8%, that means that I could afford to purchase a home just over $400,000. Let's call it $410,000. But if you go back to where rates were 3% and I had the same $3,000 a month budget, I would have been able to afford something at about $630,000. That is a 65% difference in the purchasing power just based on where the mortgage rates are alone. So these mortgage rates matter. They really, really impact affordability and the ability to unlock this housing market. The average mortgage payment has jumped up over $2,700 per month. That is on new purchases. That's according to Redfin, and that's really not accounting for the mortgage rate rise that we saw last week. As a result, we are seeing the median home price taper off just slightly. We're sitting just under $71,000. Last week, it was just over $72,000. So it has actually come down modestly. But at the same token, the listing price has actually gone up. So this is what really shocks me when I look at this data. Average listing price is coming in at about $390,000, whereas the week prior it came in at $387,000. So there's still this bifurcation between buyers and sellers. Sellers are putting their properties out there at higher price points, but their actual closed sales are coming in lower, and you're seeing this gap widen between the two. And then to wrap things up, there is no surprise here, but the listings that had price drops is increasing as well. We're sitting at 6.6%. And if you go back to early September, we started to see this upward trajectory here, and that's about when we saw these mortgage rates rise. So they have a very big impact on where these properties are closing at and affordability for the overall home buyer. Now, all of the data that I'm sharing here in this video is on a national level. It's not going into the local markets. So you want to take it with a grain of salt, but find this stuff out in your local market. Take a look at what the average price per square foot is, what's selling, how much inventory there is, the overall affordability, and then you can use that data to make educated decisions along your home buying journey. So I hope this information helps. If you found any value in it whatsoever, please hit that like button. It really helps grow and promote the channel, and subscribe. I would truly appreciate it. We'll see you on the next video. Take care.